Yes. So see the next transaction. On 2nd April, we have opened a bank account with State Bank of India. We have opened an account with SBI by depositing for rupees 35,000. So you know that whenever you open a bank account, you have to deposit the money into bank account. Some cash you need to deposit into bank account. So we have opened a bank account by depositing how much rupees cash? 35,000. Now think from business point of view. When you deposit the money into bank account, when you deposit the cash into bank account, what will happen? Your cash balance will decrease. First, what change will happen? Cash is going to decrease in the business. Once you deposit the money into bank account, your bank balance will increase. So bank balance is going to increase. So here two changes are happening. One is cash is decreasing, cash is going out, but bank balance of the business will increase. Yes. Now we know that cash balance is an asset and even bank balance is also an asset. Cash comes into business, goes out of the business, increases, decreases. Doesn't matter. Always cash is an asset only. Bank balance is also an asset. So cash is also an asset. Bank balance is also an asset. Now what the rule says, whenever asset increases, we do debit. So bank balance is increasing, we do debit. Next, whenever asset decreases, so here asset is decreasing, asset decreases, we do credit. So asset increases, we do debit. So bank account will be debit. $35,000. Next, cash will be done credit. So to cash account, 35,000. So narration will be being opened a bank account. Being opened a bank account. See the next transaction. On 2nd April, goods sold to Priya. We have sold goods to Priya. So as I mentioned, whenever in the transaction, only name of the person is being given, name of the party is being given. And they have not told anything about cash is being settled or not, cash is being received or not. If only name is being given, then it is a credit transaction. Here we have sold goods to Priya on credit. We have sold the goods to Priya. We have not collected the money. We are going to receive it in future. So goods sold. Think from business point of view. If you sell the goods, goods will go out of the business. So first, what is going to change in the business? Goods. Goods are going to decrease. Goods will go out. You are selling the goods. Have you received the money? No. But you are going to receive in future. Money receivable in future, amount receivable in future is an asset. But amount payable in future is a liability. If you have to pay in future, it's a liability. But you have to receive in future, then it's an asset. So you have to receive the money from Priya. So you have to remember, from this particular person, I have to receive the money. So you create an asset. In your books, you create an asset by the name called as Priya. Creating an asset means increasing an asset. Creating an asset or increasing asset, both are same. So two changes are happening. First is what? Goods. We know that goods is an asset. And one more change is Priya. We have to create an asset in the name called as Priya. So asset increases, we do debit. Asset increases, we do debit. Asset decreases. Asset decreases, we do credit. So debit will be Priya and credit will be goods. So Priya account debit 16,000 to goods account 16,000. Priya account debit and credit will be goods. But we remember that whenever we do transaction with respect to goods, we use that four terms, four names. Out of that, suitable name is sales. Whenever we sell the goods to customer, we write the name called as sales. So instead of goods, we have to write the name called as sales. So correct entry will be Priya account debit to sales account. Priya account debit to sales account. So narration will be being goods sold to Priya. Priya account debit to sales account. Don't use the name goods and all. Instead of that, that four suitable name. Any name is suitable that you have to use it. Yes. Now see the next transaction. On 3rd April, received a check of rupees 16,000 from Priya. We have received the check from Priya. So see here, Priya was supposed to give the money to us 16,000 because we have sold goods on credit. So that money she gave on 3rd April. So we received a check from Priya rupees 16,000. Once you receive the check, you are going to deposit that check into bank account. So once you receive the check and deposit into bank account, your bank balance will increase. Once bank will collect the money on that check, your bank balance will increase. So first change is what? Bank balance is an asset and it is increasing. See the next change. See, earlier you have recorded an asset called as Priya in your books. You have created an asset in your books in the name of Priya. Once you collect the money 16,000, that asset will get reduced. Priya's asset balance will get reduced from 16,000 to 0 because you have collected the money. Once you have collected the money, Priya balance has to become 0 in our books because you have collected the money. So in our books, there is an asset called as Priya, which you have recorded as an asset. Once you receive the money, the balance will get reduced. So first one is bank balance, which is increasing, and whatever the asset we have recorded, we have to reduce it to 0 as we have collected the money. Asset increases debit. Asset increases debit. Next, asset decreases. Asset decreases credit. So debit will be bank, credit will be Priya. So the entry will be bank account debit to Priya account 16,000. Bank account debit to Priya 16,000. Being check received from Priya. Being check received from Priya. See the next transaction. On 5th April, sold goods to Nidhi. They have just given the name of the person. They have not told that cash is being received. Just we have sold the goods. It means it's a credit transaction. Only name of the person is given without mentioning about the cash is being settled. Then it is a credit transaction. Sold goods. If you sell the goods, first what will happen? Goods will decrease in the business. Always think from business point of view. Goods will decrease. Goods is an asset. Asset is decreasing. Have you received the money? No. You are going to get the money in future. Money receivable in future is an asset. If you have to receive money in future, it's an asset. So from whom we have to receive the money? Nidhi. So in our books, we create one asset called as Nidhi. Creating means increasing an asset. So when you create an asset called as Nidhi, you have to remember that from whom you have to receive the money. So create one asset in your books. Create an account in your book by the name Nidhi. So that you remember from whom you have to collect the money. So asset increases, we do debit. Asset increases, we do debit. Next, goods is also an asset. It is decreasing. Asset decreases, we do credit. So debit will be Nidhi. Credit will be goods. So Nidhi account debit 14,000 to goods account 14,000. As we know that we cannot write the name goods. As we are selling the goods to the customer, we are selling the goods. So we use the name called as sales. So the correct entry will be Nidhi account debit to sales account. Nidhi account debit to sales account. So narration will be being goods sold to Nidhi. So whatever this 14,000 of goods we have sold on credit, we have received the money from Nidhi. On 8th April, Nidhi pays 14,000 rupees cash. So whatever the asset we created in the name of Nidhi, so from Nidhi we have collected the money now. Nidhi has paid the money to us, 14,000 cash. So when you collect the money in the form of cash, first cash is an asset. It is going to increase. In your books, you have already recorded one asset in the name of Nidhi. You have recorded an asset in the name of Nidhi by 14,000. Now that 14,000 will become zero because you have collected the money. Reduce the balance. So in your books, you have recorded Nidhi as an asset. So you need to decrease it. Asset increases. Debit. Asset increases, we do debit. Asset decreases, we do credit. So cash account will be debit. And credit will be Nidhi. To Nidhi account. So cash account debit to Nidhi account. 14,000. Yes. See the next transaction. 10th April. Goods purchased for rupees 20,000. We have purchased goods of rupees 20,000 on credit from Ritu. We purchased goods on credit. So when you purchase the goods, think from business point of view. Goods will increase. Goods is an asset. Asset increases. But have you paid the money? No, we are going to pay the money in future. Money payable in future. Money payable. in future is going to be called as liability. If you have to pay any money in future, it's a liability. So we have to create a liability in our books by the name called as Ritu, because we have to pay the money to Ritu. Creating a liability means increasing a liability. So we have to create asset and we have to create liability. So whenever you purchase the goods, goods increases, asset increases debit, and liability increases credit. So asset increases debit, liability increases credit. So your debit will be goods. So goods account debit. Credit will be Ritu to Ritu account 20,000. But we know that we cannot write the name called as goods. As we are buying the goods, we are purchasing the goods, buying the goods. So we write a name called as purchase. So purchase account debit to Ritu account. So narration will be being goods purchased on credit. Being goods purchased on credit. So correct entry is purchase account debit to Ritu account. See the next transaction, 14th April. Insurance paid. Insurance premium. Insurance premium paid is an expense. We paid an expense by check. How much rupees? 6,000. Now one important line you remember. Whenever you pay any kind of expenses, whenever you pay, whenever you are going to pay any kind of expenses, whenever any kind of expenses is being paid, you need to create an account called as expense account in your books. You need to create an account called as expense account in your books. And whenever you are going to receive any type of income, you create an account, income account in your books. So what you have to remember, whenever there is any type of expense being paid, you create an account called as expense account in your books, because you need to know what all expenses you have paid. So you have to create that account in your books. You have to record expense in your books. And whenever you receive any kind of income, create an income account. Record income account in your books. So see here what happened. Expense is being paid by check. Insurance premium paid by check. So think from business point of view. You're paying the expense. Insurance premium is an expense. So first you create an expense account called as insurance or insurance premium. So first we need to record insurance account or insurance premium account. It's an expense. So first we need to create that account. Create means increase. An expense called as insurance premium. Because at the end of the year, if you want to know how much profit or loss is made in the business, you need to know the list of incomes and list of expense. So if you have not recorded which all expense you have paid, which all incomes you have received, then how you find profit or loss at the end? So create that account in your book called as expense account. Now you know that you have paid the money by check. So if you have paid the money by check, bank balance will reduce. So If you make the payment through check, your bank balance will reduce. We know that bank balance in asset decreases. So create an expense. Because you paid the money through check, your bank balance will decrease. Whenever we create an expense, whenever expense is increased or created, we do debit. And whenever asset decreases, we do credit. So debit will be insurance premium. And credit will be bank account. Insurance premium account debit or insurance account debit to bank account. Amount is 6,000. Being insurance premium paid 6,000. Being insurance premium paid 6,000. Yes. See the next transaction. 18th April. Paid rent rupees 2,000. You paid shop rent, business rent, the premises where you are conducting the business operations. For that premises, you are paid the rent. So whenever you pay any type of expenses, first create the expense account. First, we'll create the expense account. So rent is an expense. You create it. Creating means increasing. So first you create an expense account called as rent. Now you have paid this money 2,000 rupees. So whenever you pay the money, money will go out. Cash will go out. Assume that this 2,000 is paid by cash. So if you have paid this 2,000 by cash, cash will decrease in the business. So cash is an asset. Asset decreases. We do credit. So expense increases. Expense increases, we do debit. Asset decreases, we do credit. So asset decreases, we are going to do credit. So debit will be rent. So rent account debit 2,000 to cash account 2,000. Rent account debit to cash account 2,000. Being rent paid. So whenever you are paying any type of expenses, create an expense. Increase an expense, create an expense account. And whenever you receive any income, create an income account. So see the next example. On 24th April, we purchased office furniture for rupees 11,200. We purchased office furniture for 11,200 rupees. If you see in this transaction, no name of the party is given. Why they are not given the party? Because we have already paid the money. When you have already paid the money for purchase of furniture, why you need to remember the name of that supplier of furniture? So furniture purchased, no name of the party is given. It is always a cash transaction. So think from business point of view. If you have purchased the office furniture, so first what will happen? Furniture will come into the business. So furniture is going to come into the business. So furniture is an asset. Asset increases. We do debit. Asset increases. We do debit. You have paid money. Let us you have paid money through cash. So cash is also an asset. And asset decreases. We do credit. Asset decreases. We do credit. So entry will be furniture will be debit. Cash will be credit. Furniture account debit to cash. 11,200. Narration being furniture purchased. Be careful. Whenever you buy any asset, whenever you buy anything other than goods, if you buy the goods, if you purchase the goods, then you should record it as a purchase. You are not buying goods over here, you are buying an asset. So if any transaction is relating to asset, we should record the transaction by using the name of the asset. So name of the asset is furniture, you just write furniture, don't write purchase. Purchase you should write when you buy the goods. Yes. See the next transaction. On 29th April, cash withdrawn for household expenses, for household purpose, rupees 5,000. See, who has the right to, who can withdraw the money from the business? Obviously, owner. An outsider can never withdraw the money from the business. So obviously, owner is withdrawing the money from the business. So he's taking the money from the business. So cash is decreasing in the business. Cash is an asset. It is decreasing. Asset decreases credit. If you take the money from the business, so money will decrease, cash will decrease in the business, asset decreases credit. Now whatever the money the owner has taken from the business has a right to receive that money from the owner. So business have a right to receive, it means it's an asset. Business has a right to receive this 5,000 rupees from owner in future. So it's a right to receive. Right to receive means what? Asset. So what the business will do? Business will create an asset in its book by the name called as drawings. By the name called as drawings. Drawings means whenever owner, whenever owner withdraw goods from the business or cash from the business or asset from the business, whenever owner takes any goods from business, cash from business or asset from business for his personal use, for his personal use, then it is recorded in the books by the name called as drawings. Drawings means cash, asset or goods owner has withdrawn from the business, taken from the business for personal use, then that is going to be called as drawings. So here what has happened? Cash is withdrawn from the business. So cash will decrease, asset decreases credit. But business has a right to receive that money from the home owner. So business has to create an asset in the name called as drawings. In the name called as drawings. Drawings means that much money business has to receive from the owner because he has taken that much of money for his personal use. Capital means business has to pay that money to the owner in future. Business has to pay is called as capital. Business have a right to receive is called as drawings. So right to receive means asset. To create an asset, to increase an asset, we are going to do debit. So debit will be drawings. So drawings account debit. Credit will be cash to cash account 5,000. So entry is drawings account debit to cash account. Drawings means personal expenses. Money withdrawn for personal expenses called as drawings. Yes. See the next transaction. On 30th April, interest received. Let us say we have done some fixed deposit. We have deposited some money in the savings account or fixed deposit of the bank. On that, we are going to receive the interest. Interest received is an income. Interest received is an income. Or let us say you have given some loan to your friend. On that, you are going to receive the interest. It's an income for you. Interest received is an income. Yes. So as I mentioned you, whenever you are going to receive any kind of income, whenever you're going to receive any kind of income, you need to create an asset in your books. Sorry, not an asset. You need to create an income in your books. So whenever you receive any type of income, you need to create an income account. So interest received is an income for you. So first you create an income called as interest received. Creating means increasing. So to increase an income, to create an income, we do credit. Interest received is an income. Whenever you receive any type of income, that account should be created. Whenever you pay any expenses, that account should be created. Expense account and here income account. So we do credit. Now what are this interest is there you have received in cash. So cash will increase in the business. Cash is an asset. Asset increases. Asset increases. We do debit. So cash is an asset. Asset increases. We do debit. So cash account debit 1,200. Interest received is an income. And to create or increase the income, we do credit. So to interest received 1,200. Cash account debit to interest received. Narration. Being interest received in cash. Cash account debit to interest received. Huh. Narration for previous transaction. Being cash withdrawn for personal use. Being cash withdrawn for personal use. See the next transaction. On 30th April, cash sales. Cash sales means goods sold for cash. So think from business point of view, if you sell the goods for cash, first cash will come into business. Cash is an asset. Asset increases, we do debit. Goods will go out. Goods is also an asset. Goods goes out, goods decreases. Asset decreases, we do credit. So asset increases debit, asset decreases credit. So debit will be cash. And credit will be goods. 2,300. Being goods sold for cash. But we know that whenever we sell the goods, we don't write the name called as goods. Instead of that, we are going to write sales account. We are selling the goods to customers, so we write sales account. So cash account debit to sales account. Next, 30th April. Commission paid. Commission we have paid to our agent or to our employees. We have paid commission by check. Commission is an expense. Whenever you pay any type of expenses, first you create expense account. Whenever you receive any kind of income, first you create the income account. So commission paid. Commission is an expense. So first we create an expense. We do debit. To create or increase the expense, we do debit. Paid by check. You have paid the money by check. So money is going out. Bank balance will decrease. You have paid money by check, so bank balance will decrease. Bank balance is an asset. Asset decreases, we do credit. Asset decreases, we do credit. So commission is an expense, so we do debit. So commission account debit, or you can say commission paid account debit or commission account debit. Credit will be bank to bank account. 3,000. Narration being commission paid. Being commission paid. Next, telephone bill paid by check. Telephone bill is an expense. Telephone charges is an expense. So whenever you are paying expense, first create the expense account. Telephone charges account debit. Telephone expense account. So telephone expenses, telephone charges is an expense. And to create an expense, we do debit. To create an expense, to increase an expense, we do debit. And you have paid this money by check, so your bank balance will decrease. Bank balance of the business will decrease. Bank balance is an asset. Asset decreases, we do credit. Asset decreases, we do credit. To create expense, we do debit. So telephone charges account debit to bank account. 2,000. Telephone charges debit to bank account. 2,000. Being telephone charges paid or being telephone bill paid. Next, payment of salaries. We have paid employee salary. Again, same thing in cash. So first create an expense. Salary is an expense. To increase expense, we do debit. Next, we are paid in cash. Cash is an asset. So when you pay cash, cash decreases, asset decreases, credit. So entry will be salary account debit to cash account 12,000. Salary account debit, cash will be credit. Being salary paid in cash. See the next transaction. Stationery. Stationery means pen, pencil, marker, duster, calculator. Stationery purchased for cash. Now see, listen. Here we are going to learn one concept called as materiality concept. See, whatever the stationery you have purchased, for example, let us say you have purchased one sharpener. You have paid 10 rupees for that or 5 rupees for that. So whatever the 5 rupees you have paid for purchasing the eraser or sharpener, the benefit of that will not get expired in current year only. Because sharpener you can use for second year also, third year also, fourth year also. For example, eraser. Very rarely we use eraser in our office. But we have purchased it by paying 5 rupees. So it's not like full eraser will be consumed in current year only. That same eraser will be available for next year use also. Next to next year also. So here, definition wise, if you go, whatever this sharpener, eraser, scale and all you have purchased, it's like an asset. Because entire benefit is not being consumed in the current year only. Even at the end of the current year, that scale, eraser, calculator, it's still available with you. It can still be used in the next year. So it is not expired fully, it is unexpired. But in accounts now there is a concept called as a materiality concept. Materiality means significant amount. See, if amount involved in the transaction, if it is a very small amount, negligible amount, for example 5 rupees, 10 rupee, 20, 30, even by definition wise it's an asset. Don't consider it as an asset. Definition wise it is an asset because amount involved is very small. You don't treat as an asset. See, for example, let us say Reliance company. In the annual general meeting, he is addressing to the shareholders saying that Reliance company has an asset of sharpener, scale, pencil, eraser. It doesn't look good. So money involved is very small, negligible amount, small amount. So they say that for the small things and all, even it is unexpired cost, even amount is not fully consumed in current year, you treat as an expense only. You don't treat as an asset, you treat as an expense. So not shown as an asset, treated as an expense, whether consumed or not. That full eraser or sharpener, it is fully consumed or not consumed, doesn't matter, you treat as an expense. This is because of which concept? Materiality concept. Materiality means significant. Those things which impact the decision of the shareholders, of the investors, are called as significant, material. Those which doesn't matter much, those are called as insignificant, immaterial. So the stationery and all are small things. They're insignificant things. So don't treat as an asset, you treat as an expense. So stationery purchased for cash rupees 2,200. So stationery you need to record it as an expense. First you record the expense in the name called as stationery. So stationery account debit or stationery expense account debit. To create an expense, we do debit. And you are purchased by paying cash. So cash is an asset. Asset decreases, we do credit. Yes. So expense increases, we do debit. Asset decreases, we do credit. So debit will be stationary. So stationary account debit or stationary expense account debit. 2. Credit will be cash to cash account. 2200 being stationary purchased. Stationary account debit to cash. Okay. Just see the last one more transaction. Dividend received through check. Dividend received through check. Rupees 4,000. What do you mean by dividend? Whenever you invest in the shares of a company, whenever you buy the shares of a Reliance company, Infosys, or any of the company, you are going to be called a shareholder of the company. So, being a shareholder, whatever the profit the company is going to earn, a part of that profit they are going to pay to the shareholders. They are going to distribute among the shareholders. So, profit distributed by the company to its shareholders, it's called as a dividend. So, we have invested in shares of some company, we have received the dividend, we have received money, 4,000 rupees through check. Dividend received is an income. So, as I mentioned, whenever you are going to receive any kind of income, first you create the income account. Whenever you receive any kind of income, first you create the income account. Dividend received is an income. And to create an income or to increase an income, we are going to do credit. Income increases credit. And you have received this through check. If you have received this through check, you receive the check and you deposit into bank account. Your bank balance will increase. So business bank balance will increase. Bank balance is an asset. Asset increases, we do debit. Asset increases, we do debit. So entry will be bank account debit. And credit will be dividend received. To dividend received account 4,000. Narration will be being dividend received. Being dividend received. Bank account debit to dividend received.